America's financial system just cracked. In 2026, the first U.S. bank has collapsed, sending shockwaves through markets and households. This isn't an isolated failure, it's a warning flare. Today, we break down what went wrong, who's exposed, and why this collapse signals more trouble ahead for the nation's economic future. What happened? The first U.S. bank collapse of 2026. In early 2026, a major U.S. regional bank officially collapsed after failing to meet liquidity requirements. Customers rushed to withdraw funds when reports showed the bank lacked enough cash reserves to cover deposits. This sudden loss of trust triggered a fast-moving bank run. Regulators stepped in, froze operations, and handed control to federal authorities. Branches closed, online access was limited, and thousands of customers were left uncertain about their money. The collapse exposed serious balance sheet weaknesses, including risky investments tied to long-term assets that lost value. When those assets could not be sold quickly, the bank ran out of options. This event marked the first confirmed bank failure of 2026, setting a worrying tone for the year. It showed how fragile parts of the banking system have become under financial stress. The shutdown was not random. It was the result of years of poor decisions finally reaching a breaking point. Early warning signs. Most people missed. Long before the collapse, there were clear warning signals that went unnoticed by the public. The bank reported shrinking profit margins and rising unrealized losses in its financial statements. These losses did not hit immediately, but they quietly weakened the bank's position. Another sign was heavy reliance on large uninsured deposits, which can disappear quickly during panic. Credit rating agencies also lowered their outlook, signaling increased financial risk. Internally, the bank reduced lending and tightened approval rules, showing cash pressure. Analysts flagged the bank's exposure to long-term bonds that dropped in value as rates stayed high. These red flags were visible, but they lacked media attention. Many customers trusted the bank's long history and ignored the data. This collapse proves that numbers matter more than reputation. Why this bank failed while others survived. Not every bank faced collapse in 2026, and this one failed for specific reasons. It held a large share of assets in low-yield investments that lost value over time. Other banks diversified into short-term assets, which are easier to sell in emergencies. This bank also failed to manage risk controls properly, leaving it exposed to sudden withdrawals. Leadership decisions played a major role. Executives delayed action, hoping conditions would improve instead of raising fresh capital early. Competitors moved faster by cutting costs and strengthening cash buffers. Another key difference was customer base structure. This bank depended heavily on business clients who moved funds quickly. Banks with more retail customers saw steadier behavior. Survival came down to preparation and speed. Those that adjusted early stayed afloat, while this bank reacted too late. The failure highlights how management choices can decide survival or collapse. The role of interest rates and debt pressure. High interest rates were a powerful force behind this collapse. As rates stayed elevated, the value of older bonds dropped sharply. The bank held many of these bonds, locking in paper losses. At the same time, borrowing costs increased, raising debt pressure on both the bank and its clients. Loan defaults began to rise as businesses struggled with higher repayments. This reduced the bank's income flow while expenses climbed. To attract deposits, the bank had to offer higher returns, squeezing profits further. Unlike flexible institutions, this bank lacked tools to absorb these shocks. Rising rates also slowed economic activity, cutting demand for new loans. Together, these factors created a financial squeeze. Interest rates alone did not cause the collapse, but they exposed deep weaknesses. How this collapse impacts everyday customers. For everyday customers, the collapse caused immediate disruption and fear. Many people temporarily lost access to checking and savings accounts. Direct deposits, bill payments, and card services faced delays. Even insured customers felt stress due to processing time and uncertainty. Small businesses were hit harder. Payroll payments stalled, and short-term cash plans broke down. trust in local banks weakened, pushing customers to spread money across multiple institutions. This event also changed behavior. More people began tracking deposit insurance limits and asking questions about bank stability. Online searches for safer accounts surged. Long-term, customers may face stricter account rules and lower benefits as banks rebuild financial safety. The collapse reminded people that banks are businesses, not guarantees. Market reaction: stocks, bonds, and confidence shock. Financial markets reacted fast after the collapse news broke. Bank stocks dropped sharply as investors sold shares to avoid risk. Even strong banks saw losses because fear spread across the sector. Bond markets also shifted. Investors rushed towards safer government bonds, pushing yields down in the short term. Risky corporate bonds lost value as confidence fell. The biggest impact was on market trust. Traders became cautious, slowing buying activity. Volatility increased, with prices swinging sharply during trading hours. Technology and real estate stocks were hit as investors worried about tighter credit. International markets felt the shock too, showing how connected the system is. This reaction showed that markets move on emotion as much as data. One bank collapse was enough to shake confidence nationwide. Government and regulator response so far. Federal agencies moved quickly to control damage after the collapse. Regulators closed the failed bank and transferred control to a federal authority. Insured deposits were protected to calm public fear. Emergency statements were released to stress system stability. The Treasury and central bank increased liquidity support, allowing other banks easier access to short-term funding. This step aimed to stop panic withdrawals. Regulators also began reviewing bank balance sheets across the country, focusing on risk exposure. New guidance was sent to banks about managing deposit concentration and capital levels. Lawmakers started hearings to question oversight failures. While no new laws have passed yet, discussions about tighter rules are growing. Why more bank failures are likely in 2026. The first collapse revealed problems shared by many banks. Several still hold low-value assets that lose strength under stress. High borrowing costs continue to pressure profits, making recovery harder. Smaller banks are especially vulnerable due to limited capital reserves. Customer behavior has changed. Depositors now move money faster using online tools, increasing withdrawal speed during fear. This makes sudden bank runs more dangerous. At the same time, loan defaults are rising as businesses struggle with costs. Some banks delayed fixing these risks, hoping conditions would improve. Others lack strong risk management systems. Regulators cannot close every weak bank at once, so some may fail naturally. What this means for the U.S. economy. A bank collapse affects more than finance. It slows economic activity by tightening credit. Banks become cautious, lending less to businesses and households. This can delay hiring, expansion, and investment. Small businesses feel the impact first. Without easy loans, growth plans pause. Consumers may reduce spending due to financial uncertainty. Housing markets can cool as mortgage access tightens. Confidence plays a key role. When trust drops, people save more and spend less. This behavior can slow overall growth. However, strong sectors like technology and manufacturing may continue performing well. The economy is not in free fall, but risks are rising. Policymakers must balance inflation control with growth support. How they respond will shape the rest of 2026. Banking health and economic strength remain closely linked. How individuals can protect their money now. Individuals can take smart steps to reduce risk. First, keep deposits within insured limits across banks. Spreading money lowers exposure if one bank fails. Second, review bank financial strength using public reports and ratings. Avoid keeping all funds in one account. Use a mix of checking, savings, and money market accounts. Maintain access to emergency cash. Stay alert to bank updates and policy changes. For long-term savings, diversify investments across different asset types. Avoid chasing high returns from risky offers. Strong planning beats panic reactions. Also, keep records of of account details and statements. This helps during temporary service disruptions. Protection is about awareness, balance, and preparation. Bank failures create fear, but informed actions reduce damage. Personal money safety starts with smart choices, not headlines. This collapse is only the beginning of a much bigger story. Stay informed, question the headlines, and protect your financial future. Subscribe for real-time updates, like this video if it helped, and comment your thoughts below, because what happens next could affect us all.